Hey, David, thank you very much. And Brian, thank you for joining us this morning. As David pointed out, this has been a long time in the making. It's been almost 15 years since you've had an annual meeting. Why now?
Well, I think it's time for us to put the Bible on the table, how all the business are performing. So our teammates are in there telling our investors, we've grown. We have the potential to grow even faster. We have competitive capabilities that very few have. And that growth turns into great returns, and those are the targets that were referred to. And we just have, it's a chance to do it all at once. And so we meet with investors all the time, directly with them one-to-one through the sell-side analysts and everything. But we said, you know what, we need to lay it all on at once, a lot of data, 300-plus pages of data, where people can see the tremendous value we create, $8.5 billion in earnings last quarter, and how we create it in each of the business lines and what's core to how we grow.
Hey, we can talk through a lot of those specific targets in just a moment, but just looking at the stock today, it is off by 2.8%. Year to date, performance is okay. It's up by 18%, which is a strong performance. Over the 1 year, I think up by about 25%. But, Brian, if you look at Bank of America versus the other 5 major Wall Street banks, Bank of America is at the bottom of the pack in terms of performance for the 1 year, for this year, for the last year, for the year before, and even for the 5-year. What do you think the street is hearing today that it is not helping with the stock this morning, and how do you convince them that you've got the plan over the next several years?
Well, the plan convinces them, and the teammates that are delivering it will show it. So if you think about it, we've outperformed the bank index. We have a heavy NII P&L. So we have a great investment bank, a great markets business, and that NII is growing faster. Our growth in NII for this year, 25, will be 5 to 7%. And what we will tell people is that continues for many years, and that's against an industry growth rate of 2 to 3% at best. So it's driven part by the good loans and deposit growth, and it's driven part by the repricing of the balance sheet as it grows through. So that's what produced the 31% EPS growth year over year. And, we gave them targets, a return on tangible common equity of 16 to 18%. We just achieved 15. And we'll achieve the bottom part of that range over the next 8 quarters or so, and then move into the medium to high point of that range over the next 3 years. So it's a good, solid target. It's based on an economy that continues to grow. But those returns across this franchise driving this core organic growth are tremendous. And we're also showing people how we've applied technology to continue to manage our headcount carefully and drive the capabilities of companies invest, which few can do.
You raised your guidance for return on tangible common equity to 16 to 18%. Previously, it had been towards the mid-teens. You raised your guidance just in terms of operating leverage, 200 to 300 basis points. Previously, you've been guiding towards the lower end of that. But the stock's still down 3% almost. Why do you think the stock's down today?
Look, we are a long-term player, long-term, and so what happens on a given morning, it has a lot to do. We ran up in advance of this, but look, if you're investing in our company, you should be investing for the long term, and that's what we've done. We continue to generate strong returns, strong capabilities, and continue to grow the core franchise. And I think that's one of the reasons why we did this today, is people are getting caught up in the issues of the moment, forgetting that in the end of the day, if you think about Jim DeMar and the markets team, 14 straight quarters of year-over-year trading, sales and trading revenue growth. Nobody's done that in the business. If you think about Matthew Koder over the last 4 or 5 years, moving from 4th to 3rd investment banking. You think about our consumer business growing a core consumer deposit base to $950 billion. And these things were down to long-term value. So long-term investors, here we come.
Yeah. Hey, Brian, one of the issues that the bank's been facing over the last several years was the big hold-to-maturity portfolio that you all had. Treasuries, some long-term mortgages that were locked in at much lower interest rates. You did talk about that this morning in terms of the fixed-rate asset repricing benefit that you expect to see between 2026 and 3031. You're saying it's $450 billion to $490 billion that will flow to the bottom line over that period of time. What are you going to do with that cash? And what do you see as being the place to put it now?
So if you think about our business, we have loans, we get deposits in from our customers, and we make loans. The difference with our business and everybody else is we have an extra $1 trillion of cash every day. And so back, we had to invest it to extract the value of those deposits, and we did it for the long term. And what you're seeing, that's the point I made earlier about we have 5 to 7% NII growth this year, and it will continue to next year. And other people are flattish to up a couple percent, and that's 2 to 3 percentage points for that repricing, but 3 to 4 percentage points the good old-fashioned way, growing those loans and deposits. What we do with this, we invest it all along the curve. So while we have a held-to-maturity portfolio, we have much more than that, invested $700 $800 billion invested in cash and overnight securities. So it's a huge amount. The team does a great job. But you have to think about that, extracting the value of that deposit franchise, because the advantage is on the deposit side that we have, and that's what we do.
You've been known as somebody who is a bit risk averse, and that was seen as a really good thing when you came in 2010 to manage Bank of America, because there were so many problems after the financial crisis. It needed somebody who was going to look at things in a very different perspective. Some people call it risk averse. Other people call it risk management. From your perspective, is it more than just semantics on this? What's the difference between being risk averse and being a really good risk manager?
I'll let you all parse those words. At the end of the day, we've grown. Look, what's the issue of the moment you hear about today? Commercial credit quality. Ours got better in the third quarter. Consumer credit quality. Ours got better. We have not had a deep recession, other than the pandemic with all the stimulus that covered up, since 2008, frankly. And so think about how long we've gone without a consumer side, major change in unemployment, et cetera, and you're still running 4.3%. So we run our portfolio so to perform over many periods of time, and that allows us to have less capital and stress tests and things like that. On the other hand, Jimmy DeMar puts $1 trillion balance sheet in the market every day, and that's helped grow those revenues. So we take a lot of risk in the company, but we try to take it the wrong way so that the growth we have sticks to the ribs. And we know, certain aspects that you hear about just in the market over the last few months, we know those come and go, but the key is just to keep driving the business. So private capital, private lending, all this stuff you hear about, we have an answer for that for our clients. We have made a commitment to a pool of capital that will support them when they need it, and that'll be $20 billion. Sounds like a lot, but in the case of $1 trillion balance sheet, not a lot. So we're driving the competitive responses, credit card growth. We've grown the core book nicely, and we plan to grow it in the future. So as you think about the company, it's that stick to the ribs growth we're after. We're not after running it up and running it down. Frankly, we saw that before the great financial crisis, and we understand what it's like to take the biggest consumer brand in America and have to deal with the aftermath of a consumer side unemployment level.